Hey, welcome to the New Home Insights podcast by John Burns Real Estate Consulting. I'm Dean Worley, your host. Each episode, we're going to bring you some of the best minds in the housing business talking about some fascinating topics or trend or innovation or issue, just like the one you're about to listen to. Enjoy. Hey, today on New Home Insights podcast, we have not just a very special guest, but a very special guest host. The host is John Burns of John Burns Real Estate Consulting. He will be interviewing Bob McLeod of Newland Communities, one of the biggest and best master plan community developers on the planet. Bob, you did a great job. This is a very informative podcast. John, don't get too comfortable doing this. This is Dean Worley, your usual host for New Home Insights. Enjoy this episode.
Okay, well, I'm super excited today. We got Bob McLeod, the head of Newland, who's the largest geographically diversified master plan community developer over the last 4 to 5 decades, in my office. And Bob, why don't we? I won't do nearly as good a job introducing yourself, and I'm sure you'll do a very humble job of introducing yourself. But why don't you tell our listeners a little bit of background and then we'll spend some time giving them a great education.
Oh, good grief. Thanks, John. I'll give you the Cliff Notes version of this. I had graduated from Berkeley and got hired by Chrysler Corporation and got a couple lucky breaks and became their Los Angeles district manager. And at Chrysler, I learned a couple of things. One is that an automobile dealership has a lot of different businesses, new and used car sales, service and parts, but finance and insurance and leasing and body shops and things like that. And they sell a bunch of products, different cars, different trucks, and that sometimes the dealers were not interested in what the market was doing. They sort of like a particular brand or a different type of model, and that's what they stored into their lots. And the goal was to try to show them that their market was selling a certain other kind of product. Chevys and Fords were selling something else, and you ought to step up and be in that game. So right. I learned a lot from them. Got hired away by a mechanical engineering firm, one of the largest in the world, although based in San Diego. And they had a lot of different small businesses. And somehow I became someone known to go in and see what you can do with these small businesses. Okay. And I did that, and we had a lot of different things, filtration systems, pipe manufacturing businesses, real estate development businesses, et cetera. And that led me to a job in Florida, with a company that bought several larger companies with a lot of various corporate assets.
What year about is this?
This is 1992. Okay. And so in 92, I head to Florida. And after looking at some of these, I got assigned the land assets and the land development company, which I knew nothing about. And I went and talked to a guy named Zev Cohen, nice young engineering guy, and so I said, "Okay, Zev, what's my first job here?" And he said, "Well, the first job is you have to get entitlements, Bob." And I said, "Well, what's an entitlement?" So that's my beginning of the development business. And from then on, we developed a lot of different things around Florida. I then got called back to California by the same engineering firm for other issues, all real estate related, as the company was privately owned by two brothers. And I worked on that. And on moving back to California, I met a guy named Frank Dubensky, and Frank was the CEO of Genstar for all the United States. And we hit it off, and we'd have lunch at the Board and Brew in Del Mar once a month, have beer and sandwiches and talk. And one day he said, "Well, I need you to come to work for me because I got some problems in the Southwest." And he hired me, and I was to help him out on California, Arizona, and Nevada. And I think we did that. And when Frank retired, Genstar then promoted me to his job as CEO of their U.S. real estate assets.
That was about
1984, I think.
okay. And Florida was more 72 then.
Yeah.
Okay.
72 to 80, 80 to 82, then in 82 with GenStar.
Yeah.
And then the promotion in 84. And then in 85, GenStar got bought out in a hostile takeover. And I was able to secure a new partner to buy the U.S. assets, American General out of Houston, Texas.
Yep.
And we did that. And but at the time, we also sold our container business to GE Capital. And they secured the rights of the name GenStar for 7 years. And so we had to come up with another name. So I had the employees of the company submit names, and after a series of what would work and what didn't work, we came down to Newland.
Okay.
So that's how that game survived. And over the years, we've obviously bought a lot of projects. We bought a lot of portfolios. The Teamsters portfolio, the Canadian GenStar portfolio, it's a different group. The Terrabrook portfolio, et cetera, over time that built the company up at one time where I think we had close to 70 different things, small master plans, et cetera, going on in the company. But we're down to less than 30 now, and larger projects, and certainly doing well.
I look, you're in 11 states right now. I know you were at 14 at the peak. Do you have any idea how many lots you've developed over tens of thousands?
It might even go into six figures.
Okay.
But I guess I've never actually kept count. Right. I've never kept count on how big we were. I never kept count on how many projects we had at the particular time. I mean, I was just told it was 70 as I came here to see you at the peak. Okay. But because that wasn't of interest. I think the only interest was you were going to develop a community for people, and you're going to give your financial partners a return on that. And that's the important thing. We focused on every individual project as a separate deal. We didn't focus on Newland, if that's the right word, as a business.
Right.
Even though it was a business.
Right. So you have this great business running all these separate communities all over the country. I want to come back to that later. We'll talk a little bit about some of your favorite communities and doing business in all these different states and how different it is. And I'm particularly interested in how different it is to work with the builders in these states too. But let's start off with some of the lessons learned. And I've heard you talk about this in the past, and I always take copious notes when you talk. For our audience, what are some of the lessons learned over the last 5 decades, and particularly managing through all of those cycles? I mean, you got into the business, it sounds like 7 years before the S&L crisis, and then you had the tech crisis, and then we had the Great Recession. But in the meantime, probably 8 out of every 10 years have been good years. So how do you manage through that?
We've, considering the GenStar years that actually started in 1968, I guess this will be our 52nd year and 6 recessions. I think there are 3 things. And first thing is product diversification. I go back to what I told you earlier in this conversation, my automobile days.
Yeah.
A master plan is like an auto dealership, pickups and SUVs and sedans and hatchbacks and electric cars, lots of different things at lots of different prices to serve a whole market of people and customers and what they wanted to buy. And the master plan is exactly the same thing. We have a whole series of products in the master plan. Right. Everything from apartments to townhouses to zero lot line homes, all sorts of lot sizes, commercial, office, retail, obviously schools, parks, libraries, police stations, fire stations, etc. But we have, it's this diversification. And in good times, we tend to sell more of the expensive stuff. And in bad times, we tend to sell more of the less expensive stuff, but we're always selling. And I guess the second thing is, besides the product diversification, is geographic diversification. I mean, being in different states during these downturns as has saved us in a way. If you think about it, I mean, we had the oil crash in Houston in the 80s. California went absolutely into the tank in the early 90s. Of course, we had the terrible recession of the 2008, 2009, which Texas and some other states actually did very well.
Right.
So having that geographic diversity was able to balance our revenues quite well with our financial partners, because everybody goes in and out of a recession at the same time. Even cities within a state go in and out of recession at the same time, at different times. And I think it's really important that we keep that geographic diversity going. And it's one of the things I think that really benefited us. And third, and probably as important as the other two, maybe even slightly more important, is a financial partner who has the vision of the business and who understands that a community can be 3 years, 5 years, 8 years, 12 years, and you make money by developing the community and selling it out. You don't make money as if you were a fund, and my fund's up in 5 years, so we have to liquidate. I mean, we bought a lot of projects where funds had to liquidate in a particular period of time. We've been lucky with Genstar, American General, CalPERS, and Sekisui, our current financial partner, because they've always had that long-term vision. And they always knew that they're investing in a business that we're going to give them revenue, operating profits, and a return. And that was extremely important. And they all did one other important thing. I think the most important thing is that when we went to get debt, they guaranteed the debt on a corporate basis. They didn't guarantee the debt on a project-by-project basis. Because back in the old days, my dad's days or whatever, is that the bank were your partners. You went into business with the bank, and you knew already, and the bank knew that you're going to have good times and bad times, and your business plans are going to reflect that, and you're going to help each other through it. Well, in 1981, with the first part of the dual recession we had, those 2 or 3 years, that came to an end. And now the banks just foreclose. Once you have a downturn, they foreclose. And as you know, all these land projects go out. And what do? Do they try to bring them back? No, they sell them at 30 or 40 cents on the dollar. Yeah. And we have bought a lot of foreclosures at 30 and 40 cents on the dollar. It's an incredibly stupid way of doing business, but you can't deal with banks anymore in that kind of framework. We need a partner who is strong enough, who can then guarantee the program. And people said, well, why don't you just buy a project without debt? Yes, that can be done. But when you do that, the return required by many of the financial institutions are high. So you're talking 18 to 20% unlevered return. Well, those are the only returns you can get. I'm sorry. Only you can get when I buy a project at 40, 50 cents on the dollar. You can't buy something new, get entitlements on it, 2.5 years later start selling something, and then expect that return to be.
Unless you get really lucky on the time.
And you can get lucky, and we've gotten lucky, but we've gotten unlucky. Right. I mean, so, I think over a period of time, we have averaged, I know we went to CalPERS in 94. From 68 to 94, we averaged about almost a 17% levered return. And oddly enough, that return remained the same when we had to present to CalPERS in 2009. At
3 years into the downturn.
In the downturn,
right.
We actually got that same kind of return. I think it's 16.9. It was in that range, because you have it's over time. We find that these projects, they flow. It's like a wave. You good times and bad times, and there have enough time involved in them that you can mostly work it out. Sometimes you can't. We've had some we could not work out.
You might appreciate this. Every time I hear a banker say, well, we're relationship lenders, you laugh. I laugh at them too. I say, well, do you have a special assets department? It's like, yes. Okay. Well, then the relationship is severed the minute the market is bad and you give it over to the mean guys, right?
That's exactly right.
Well, Well, that's good advice. And so I'm guessing do you still underwrite to a 17 today with interest rates so low?
I think that we've been very lucky with Sekisui. They've been an incredible partner, not only through their financial strength and their ability to get debt at extremely, I think we pay 180 basis points over LIBOR.
Oh,
so
geez.
and that's wonderful, obviously, for the returns. But they've been exceptionally well in understanding our business. They're very vision-oriented. They're very sustainability-oriented. They fit right into our business plan. They understand exactly what we're trying to do. And they're probably one of the few major partners that we had that's been able to get that. But that's what they've been able to do for us.
Yeah. And I've seen the articles on their home that they're building in Las Vegas. They're bringing some of the Japanese technology here to the United States. I think they're going to completely change home building in the United States.
It's interesting because when you look at the home in Las Vegas, and we looked at it last week, they built 60,000 of these homes in Japan. So this is not a new thing
per year
for them. Well, this particular style home, they built 60,000. They do about 50,000 homes a year in Japan.
Okay.
But you have to really see it to believe it. And I'm not a construction guy, so you're going to have to forgive me. But even I was wowed by the way they put these pieces together that fit perfectly. And how they put these things, how they put this house up. And when you look at the house, you won't believe it was built, the components were built in a plant. Right. And the air filtration systems, the photovoltaic tile roof systems for their solar, how they store it, the kind of the skin of the house looks like it's brick, but it's actually ceramic. I mean, it's just, these houses withstand fire, earthquake. I think Sekisui is extremely proud that in I think it was the Kobe quake they had, I don't know how many homes were damaged. Not one of their homes was damaged in an earthquake because of the systems that they have and how they so in my mind, if in California with earthquakes and fires and in Florida with hurricanes, I think at least the construction of this home, if not the design, which I think is absolutely beautiful, will really work. And you can do whatever you want. You know, you're going to see the home, it's 5,400 square feet, but you could be 2,000 square feet. You know, to them, it doesn't matter. You just tell them what you want and they'll put it in the plant and that's what comes out. So it's incredible.
We're getting off topic a little bit. No, it's my doing. I'll bring Joel Shine in and we'll talk about it sometime because that would be good. So maybe if you could, I think you're one of the only people that does all these huge land developments all over the country. Maybe if you could compare and contrast doing business in different states, not just with entitlements, which I think people know where things are harder or easier to get things done, but even dealing with the home builders and creating segmentation and are the home buyers that different? Maybe you could give us some insight.
I think I think everything is different. Okay. I think every state is different. Every city within every state is different. I think there are areas in the city that are different. And I think that the customer is different in every one of these areas, what they need and what they don't need. Even if you have a customer that moves from our project in Minneapolis to maybe a project in Phoenix, they soon find out that they want to blend in with Phoenix. They don't want to bring their home that they used to live in Minneapolis because they've taken a job, they brought their kids. They don't want to be odd. They want to be part of a community. And that's the basis of what we do. And so all that has changed. I think every land form in every area that we're in is all different. Sometimes we have a land form that it speaks for itself. We just have to not screw it up. Right. Other times it's a land form that needs some enhancements. And other times it's a laser level rice field in Houston, Texas. And we just simply have to create something here. And we try to create what the local people tell us they are going to want. Not what they want. We've already seen what they want. We can, just like anybody, drive around, we can see what they want, we see what they want. We want to know, what do they need in the future? What are their needs? Who are they going to be? How many kids are they going to have? Are they going to have any kids at all? What's that market going to be? And it's entirely different. Every state is a different, obviously, landform, different in terms of job base, different in terms of people's needs. But in Houston, for instance, I'll pick on Houston again, we had 2 projects. And the projects were on the same road, 4 miles apart. The door-to-door of these projects, 4 miles apart. They were in the same school district. The landform was exactly the same, heavily wooded with lakes.
Okay.
And yet the people who moved into these were different. The people who moved into what I'll call the northern project worked more at the airport and the jobs around the airport, and they wanted more of a closed-in community. And they would not live in the other community. The other community,
Closed in, you mean gated or?
No, just walls.
Just walls.
A lot
okay.
of wall systems and things like that. They wanted to be behind the walls. That was their program. The other community wanted to be open. And they all worked at the medical center, or at the port. So that was a different group of people. And what their needs were in that community were entirely different. So when you design the amenities and how the recreational facilities looked and where the hiking and biking trails went and what kind of parks you had, it was all different. Even though you'd say, well, they're only 5 miles apart. They're in the same school district, it's the same system.
Right.
They're all different. It goes to, if I digress for just a second, it goes to a plan about the customer. Who are they? I talk about the fact that if we had a husband and wife, and one of them worked for IBM, and the other one was a professor, and they had an 11-year-old boy and 9-year-old girl. Right next to them was another couple, same thing. One of the spouses works for IBM in the same office, in the next desk.
Okay.
The other professor works in the same school, in the same department. The kids go to the same school. They make the same salaries. They appear to be exactly the same. And yet, if you make the mistake of assuming that, you're going to lose, because when you get into who they are, you find out that one of them is very low key, very laid back. They're very unassuming. They don't want to spend a lot of money and show what they have. They're more integrated into the land and into their community. The other group, very ostentatious.
Right.
They want their house to tell who they are. They want their cars to say who they are. It's a whole different thing. And if you have a whole bunch of number ones, you have to sort of design your community to deal with that. And if you have a whole bunch of people who are in the number 2 group, you have to design a different community. So if you forget, or at least a section of a different community. So if you forget who the customer is, I think you're in terrible trouble. And I think Newland and our people, you deal with them. I think they're the best at understanding and trying to help us figure out who is the customer going to be.
Oh, your market research department is bar none, second to none.
Thank you.
I mean, the kind of segmentation you've done, and some of the work I've seen you do with like who's out there and who's actually buying in here, and finding the mismatch, like you would talk about, like, okay, we need more of an ostentation product because we don't have the ostentatious person buying it. I think that's brilliant. And you go back and talk to Wall Street a lot. I talk to Wall Street a lot, and for them, it's all math. Prices per square foot. And I'm like, is that how your wife helped you buy a house? Was price per square foot, or was it really what you wanted?
Or what she wanted?
Yeah, what she wanted. Really, exactly. That's all that matters at the end of the day. So, that's amazing. Now you deal with builders all over the country too. Right. Do you find that we don't have to name a builder, but are they very different by market and how they negotiate with you and how they do research, and or is it pretty similar?
No, it's very different. It has to do with 2 things. One is, who's the regional president of the home builder? The person. Who is he? And second is, what market is he in? And what does he think he should do in that market? So even though we have a home builder that we want to do something different. And he says, well, I've never done that. And this market won't accept that. And so I don't want to do it. We said, well, 8 of your other regional presidents around the country are doing it. So,
which you probably didn't even know.
Yes, exactly right. So that becomes a problem. And especially, I think some of the regional presidents of home builders who have dealt with us for a long time, I hope, and I think it's true, trust our research.
Right.
And when we tell them, you need more homes with the master down in this particular segment, most listen to us. Some don't. And then they get off kilter. And of course, then we're always, well, I'm not selling my home. Well, I understand, but remember how we told you that your market in this area, people want, doesn't make any sense to you, but they want master down. That's what we've shown you that they want, but you didn't build that.
Yeah.
So we can tell you, we can dictate in terms of square footage and lot price and lot size and a lot of things, but we can't actually physically build your house for you.
Yeah. So, we do a lot more market research for developers than builders. And when I say that, people are really surprised. But if you think about it, the builder's going to go into your community and build 100 homes in 3 years. He's going to be in and is out. I mean, you're in these communities for 7 to 10 years doing thousands of homes. So you can amortize the research across a much bigger portfolio. Do you think you're able then to share that research with the builders and to get them to pay more for the lots because now they've got more confidence in the market that they wouldn't have had thanks to you?
I think we get them to pay a lot price that we think is acceptable for the product of which they want to build in the area in terms of competitive. Other master plans, we can't be overpriced in comparison to other master plans, but you can't be underpriced either. But what we try to do is try to explain our segmentation, and our segmentation gets called into question a lot in some of the markets that we're new into, where a regional president hasn't dealt with us. Their home office has dealt with us in 10 states. And we're trying to explain that, no, you seem to build really well in the 2,000 to 2,400 square foot range. We're going to put you on a 50 by 100 foot lot. I'm just making this up as an example. And they said, well, no, I've got to have a home that's 1,400 square foot to 4,000 square foot. No, no, that won't work for us. Why these projects are successful is that everybody has their niche, which is segmentized based on who we think the customer is in this project, in this city, and at this time. Yeah. Doesn't matter. It will change if we come back for phase 4 of this project and you're in phase 1. Phase 4, I'll tell you, will be entirely different. We're going to come back with a whole different program for you if you're still building with us 3 or 4 years from now.
Any lessons learned on segmentation?
Yeah. Sometimes one of our biggest lessons learned and one of the biggest mistakes that we make, we tend to sometimes over-segment the market. And we've had so many successful larger projects that we were able to do that with, that we made the mistake of thinking every project can do that with. And that's just simply not true. And so we've had to a lot of times retool, expand the segmentation, bring a different kind of builder base into that, because it's not going to kind of take the segmentation that a Cinco Ranch takes or a Telfair takes.
So an example might be you might have 3 communities that are somewhat in the same price range, but the homes look very different. One's an alley load and the other's not an alley load, and that works in some areas and maybe in some economies and not others. Is that?
That's correct.
Okay,
that's exactly right.
Okay. Yeah, I've noticed that the segmentation, when you get really tight, tends to work when the economy's strong. It's when you're really segmented tight that's when everybody beats each other up during a downturn.
That's exactly right. That's exactly right. And it's a lesson learned. I mean, so we try not to make that mistake too often.
Yeah. Well, we've got a lot of people who listen to our podcast who are up and coming in their careers. So why don't we close it with some lesson learned? What advice would you have for people getting into development today?
I know this is a issue I'm hammering on, but it's all about the customer. You have to figure out who the customer is going to be, what they need, what their needs are. And if you're in the development business, you're going to deal with a piece of land. You got to figure out what that land is going to do. What does it look like? How can you enhance it? How can you make this land fit the needs of the current customer you're going to be dealing with? Just don't take this as you're going to develop some streets, going to sell some lots to builders, and you go down the road, because that's not my game. And that's not the game of a long-term master plan that's 6, 8, 10, 12 years in the making.
So do you have the vision for what you can do with the land? I'm guessing you have a competitive advantage because you've done this all over the country. I know so many land developers that are really just single market land developers and don't get on a plane and see what's going on around the rest of the country. Do you think, I mean, what advice would you have to somebody in that, maybe somebody's got a great project in Dallas and to figure out what to do with it, what would you do with that?
I send our people around to see all our competitors' projects. And they're wonderful. Just in the
local market.
Not just the local market. Okay. And they're wonderful. They do wonderful jobs. We're not the only one out there that does a great job. But the whole point of that is to see what worked in that market. You can't take back something that you saw in California and put it in Phoenix, Arizona. No. You have, but to see it, to see what they've done, to see how that creativity has taken place. I think it benefits your creativity. But you've got to go back, look at your land, look at your customer, and design something for them based on the knowledge that you've seen from everybody else. You don't duplicate that. You try to get what the customer wants and what the land tells you it should be, but it helps to see everybody.
So go get great ideas and then figure out how to make them. Which ones work?
That's exactly right. Locally. For you.
Okay. Well, that's awesome, Bob. I'm so honored you spent some time with us and you're educating thousands of people on our podcast, and we're really fortunate to have you. Thank you so much.
Thank you, John.
You just listened to the New Home Insights podcast with John Burns interviewing Bob McLeod. Hope you enjoyed it. We will see you next time.